Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. So, equity markets faltered and oil prices surged overnight on fears that the US-Iran ceasefire will collapse, although Iran said it is considering attending peace talks with the United States in Pakistan. Stocks on Wall Street came under pressure ahead of the two-week ceasefire deadline, which expires on Thursday our time. The CBOE Volatility Index gaining after falling for the past 8 sessions. In company news, Apple named insider John Ternus as its next chief executive. He'll take over from Tim Cook as the iPhone maker gears up for industry change. Spurred by AI, Ternus has recently overseen the company's hardware engineering efforts, and Cook will become the company's executive chairman. Amazon is investing an additional $5 billion in Anthropic, with a plan to expand that investment to as much as $20 billion over time. Anthropic, which makes the Claude chatbot plans to spend more than $100 billion over the next 10 years on Amazon's cloud technologies and chips. Meta snapped a 9-session winning streak. Netflix fell to be down around 12% since announcing its quarterly results and the departure of its co-founder last week. Adobe rose as it announced a set of AI agents that aim to help corporate customers automate digital marketing and other functions. Shares of US energy companies largely tracking the crude prices higher, while gold stocks tracked bullion prices lower and copper prices fell on ceasefire doubts, taking US listed shares of BHP and Rio Tinto lower. Well, Iran has said it's considering attending peace talks with the United States and Pakistan. However, Iranian Foreign Minister Abbas Araghchi said that continued violations of the ceasefire by the US are a major obstacle to continuing the diplomatic process. President Trump has said it's highly unlikely he would extend the 2-week ceasefire with Iran, which expires on Thursday, if a deal is not reached before it ends, and that the Strait of Hormuz would remain blocked until an agreement is finalised. And President Trump has said he believes the nuclear deal the US is currently negotiating with Iran will be better than a 2015 international agreement to curb its nuclear program, saying the deal that we're making with Iran will be far better. Meanwhile, Kevin Warsh, President Trump's nominee to lead the Federal Reserve, will tell his Senate confirmation hearing on Tuesday that he is committed to ensuring that the conduct of monetary policy remains strictly independent. According to prepared remarks he released, he said inflation is a choice and the Fed must take responsibility for it. He's repeatedly criticised Fed policymakers for blaming the post-pandemic burst of inflation on supply shocks. Well, US Treasuries, little change. The 10-year yield was at 4.25%, the 2-year at 3.71%. Australian 3-year government bond yields, they fell to 4.6%, the 10-year down to 4.95%. The US dollar index slightly lower. The Aussie is trading at 71.8 US cents. Oil prices jumped around 6% on uncertainty over peace talks between the US and Iran. Brent crude futures settling at around $95 a barrel. Gold fell to a 1-week low before recovering slightly to be close to $4,820 an ounce. Copper fell 1%, iron ore rose 1% to 109 US a ton, and Bitcoin trading just below 76,000 US dollars. Well, let's get across all those market moves. Steve Sosnick is the Chief Market Strategist at Interactive Brokers. He joins us again now. Steve, great to catch up as we normally do on a Tuesday our time, Monday night yours. And how are markets interpreting what they're hearing, particularly headlines at the moment in the Middle East, as we head towards that ceasefire deadline?
Good morning, as always, Andrew. I think, it's interesting. Markets right now are just really in the mood they're in the mood to do what they want to do, and that's go up. And so I think as long as a headline can be credibly interpreted as something that doesn't make the situation worse, and I say that as opposed to something that makes the situation meaningfully better, as long as it doesn't make the situation worse, the market is willing to take it in stride. At this point, I'm fairly convinced that there are algorithms that buy any time the president mentions something resembling peace talks, because we do see a lift on that. We've heard, and it's become quite reliable, and actually to the point where I think the administration realizes this, because they throw around the term quite liberally. And I think that, so, you've got this situation where markets are waiting for good news. They don't really care the source. One good situation, to be fair, is that the bond market has been relatively stable. It seems to have found a level. Obviously, the early part of earnings season has come in pretty well, although it's been leaning toward the banks. But we have not seen analysts cutting expectations or companies giving very poor guidance into this number. So you can argue we should have been doing better. The question is, should we be doing better at pretty much an unprecedented pace that rockets us back to very high valuations?
Do you feel as though President Trump's commentary is more about moving markets than actually reflecting those negotiations that are going on?
I wish I could say something other than yes, I agree with that statement. I think they are designed to mollify markets, and to be fair, I think markets want to be catered to. Again, I think it's not a coincidence that that this rally really took hold a year after the tariff tantrum, and I think that lesson was very much in investors' minds. It's why we didn't go down more during the worst of the fighting, and it's also why we sprung back so quickly, because no one wants to miss it. And one of the reasons the market acted so poorly last year was at first the president and the administration seemed tone deaf to markets. Remember that comment, bond markets got yippy. Well, that came after the president and Treasury Secretary Bessent and Commerce Secretary Lutnick basically told the markets, deal with this. And the markets didn't want to deal with this. And now this time, I think the messaging has been very clear. I think the timing of some of the announcements that they came, let's say Monday morning at 7:15 our time, some of them, we didn't really get one today, but this is the kind of, I get the sense that there is a lot of messaging going on, specifically designed to assuage investors.
Steve, I was just looking at a note, and you're saying to many veteran investors, the combination of high oil prices and yields alongside a smaller chance of rate cuts is not the recipe for an explosive increase in stock prices. Just before you came on, we were talking about perhaps that generational divide that's at play at the moment. Talk about veteran investors. What about the young and new investors that we're seeing in the market? How are they playing this?
Well, I mean, we saw our customers, and I can't really do a demographic breakdown, but we saw our customers aggressively buying, particularly into the end of March. They did actually, to their credit, start to take profits into this rally. So even they're not chasing this. But when I sit down with more veteran investors, I mean, very specifically, last week I had dinner with a friend of mine, a social dinner, who co-managed very much a large, second in command of a very large New York hedge fund. And the first thing out of his mouth when we sat down was he said, before we just talk about our families and stuff, I got one question for you about the markets. What the? And I won't finish the sentence because I think it's a family network. But basically, this is the kind of thing I've heard from any number of people who have been around markets for all, because they remember that this is always, the Strait of Hormuz has always been one of the big black swans. They also remember that, when you get big spikes in oil prices, although this didn't spike as far as it might have, but when, they're looking at this saying, we're rebounding as though we're coming off of a generational low, which is the type of move. I looked into this. This is only the third time since 1980 that the S&P 500 has rallied 3% or more in 3 consecutive weeks. The other 2 times were 1982, which was when then Fed Chairman Volcker basically signaled that the inflation fight that he'd been undertaking for the last 4 years was complete, and that marked a big change in monetary policy after a major series of bear markets. And the other time was May-June 2020, when the quantitative easing kicked in. This was again after a bear market move. Quantitative easing kicked in, stimulus checks started to go out, other fiscal stimulus went through. We've had nothing of that nature. As a matter of fact, we've taken 2 rate cuts off the board. So I think a lot of people who remember some of these historical precedents or remember some of the bad markets are saying, this isn't the recipe that we've had to get a market going. I think younger investors, though, have taken to heart the idea that every dip is a buying opportunity. And to be fair, I'm not going to criticize them for that, because in their experience, every dip has been a buying opportunity. So if something's working for you, why stop it? And this is yet another situation where I think, the momentum has taken over. There's a lot of FOMO, and it's not, again, it depends on your, I guess on how many battle scars you have on you. But if sort of your investing experience came through, really came in sort of the post-global financial crisis, or certainly the post-COVID era, you've been taught pretty meaningfully that, just close your eyes, buy it, and when it starts to rally, just keep buying it. So I do think it has a big generational component.
Would it be wise, in your view, to have a defensive bias at the moment then, Steve?
I'm an inherent contrarian, so I look at this and say, this is just so extreme. It's such a short period of time. I'm going to put it this way: there's sort of I have a low probability, and I don't really know what the number is, that this is what we call a blow off top. And one of the other examples, when NASDAQ rallied, there's a lot more examples of NASDAQ rallying 3% 3 times in a row. But the bulk of them occurred in 1999 and 2000, including the absolute last gasp of the market. Now, these are very infrequent events. They're very rare, and I don't want to draw too many conclusions to too many parallels between .com now. But I think there's a non-zero probability that this is what we call a blow-off top, which is just sort of that last hurrah of buying. And if this situation, the Persian Gulf, rectifies itself relatively quickly, which still means that tankers are not showing up, let's say in Australia, for another 4 to 6 weeks, even if this were to magically fix tomorrow. We still have the situation, if this persists, it's hard to imagine this thing continuing on. And we'll see. Now we have earnings season coming out, starting now. I think CFOs will, I'm sure, exploit the situation in the Gulf to say, oh, how do you expect us to offer guidance? We don't know what's going on over there. So we're not going to change our guidance. We're not going to offer you any guidance, and investors will just lap it up. But I do think that there's, I think it was right to sort of, follow the momentum higher, but I think this has gotten to such an overbought extreme, from an oversold extreme to an extraordinarily overbought extreme in such a short period of time without a clear catalyst.
Steve, great to get across your thoughts. Thanks for joining us from Interactive Brokers.
Thanks, Andrew. Take care. See you next week.
Okay, let's turn our attention to the open. Just a minute or two away. S&P ASX futures, they're up 0.5%. So looking for a very positive start. Let's see if that actually materialises very shortly. Stay with us for the open.